full-blown trade war averted? I think based on what we were already talking about, you got a bunch of headwinds against any positivity here.
Well, that's wishful thinking about the trade. Secondly, we have a market that's, irrational exuberance on steroids based on the false premise that the business cycle has been abolished. After all, we're in month 108 of the weakest business expansion in history, 11 months from the record, which happened in the 1990s under far more propitious circumstances. And now we're facing three headwinds that can only mean trouble for the economy and the market going forward.
All right.
First, you have a unhinged, crazy man in the Oval Office when it comes to trade. He's a lot worse this year than last year. Because last year, what he wanted to do, taxes, getting rid of Obamacare, that required congressional action, massive politics, negotiations.
And he had support of his party
and
for
he had
those
some, and he
things,
barely
too.
got it through, and it was a bad tax bill to begin with. But the second point is, this year, like some kid, he discovered the matches in his mother's pantry. And the matches are trade policy and these ridiculous national security investigations under Section 302. And he is running away from with this. He is triggering reactions and counter-reactions and political repercussions around the world that he doesn't even remotely appreciate. But the very idea that we need steel as a national security issue is ridiculous.
Right.
The world is drowning in 500 million tons a year of excess steel. DOD uses 2 or 3 million tons and can get by with less. There is no issue. The same with automotive. They're about ready to do an investigation on automotive on national security grounds. And the cars come from Mexico and Canada. I mean, this is ridiculous. So this is not settled by any means. I think the billiard balls are going to be bouncing all over, and this is a real headwind. But more importantly is the Fed.
Right.
It is pivoted to QT in a major way for the first time in history, and that's the action.
Right.
You know, the 3 rate hikes or 4 rate hikes, that's immaterial.
But it's actually the drawdown here.
It's the drawdown. $600 billion a year at an annual rate beginning in October. They're phasing into it. And people forget that as recently as 2002, the entire balance sheet of the Fed was $590 billion. In other words, they're going to be shrinking, dumping bonds to a magnitude that's greater than the entire Federal Reserve balance sheet that took them 94 years to achieve by 2002. And it's not just the Fed, the rest of the central banks of the world, one way or another, are moving in that direction. Remember, 2 years ago, the central banks were lifting $2.4 trillion of government and other paper out of the market in QT, in Europe and here, the UK, Japan, and elsewhere. By next year, it'll be at the flat line, and within 15 or 20 months, they're going to actually be shrinking their collective balance sheet. Now, the third thing is you have basically the federal government launching into a massive fiscal stimulus in the 10th year of a business expansion, and they're going to borrow $1.2 trillion in the year ahead.
I want to make sure that my colleague Yvonne actually gets some questions in as well. Okay. These are all really terrific. I'm loving it. But Yvonne.
Sure.
David, let's bring it back to the market, because we've seen we're back to this kind of exuberance that we saw maybe towards the start of the year once again. To what extent do you think that we are seeing kind of this return of animal spirits after Trump's tax cuts? Because CapEx in particular has been picking up, especially when it comes to the tech side. There is a sense of renewed investment activity.
Oh, I think that's very temporary, very minor. Almost all of the tax cut is going into stock buybacks and M&A deals. We had record stock buybacks in Q1. The numbers that I see is that during 2018, the corporate sector will spend $2.5 trillion on M&A, dividends, and stock buybacks. That's not going to cause the economy to grow. It may give a temporary lift to the market, but the market ought to be rational enough to see through it, because it's not sustainable, and it's being funded with borrowing, which goes to my point before, that $1.8 trillion of paper will be heading for the bond pits looking for a home. 1.2 that the Treasury's borrowing in the year ahead, $600 billion of old bonds that the Fed is dumping. We've never had anything like this before. There is going to be a massive yield shock. It's not priced in, and the rubber's going to meet the road. But you can't go by the market. This is a day trader's market. This is a machine, robo-driven market. I think it's the most insanely overvalued market since March 2000. And it's just a matter of time before people wake up to the fact that there's a recession coming at us.
David, then let me show you a chart real quick here about the earnings picture, because that's what is getting all the bulls quite excited. I mean, the profit from the S&P has risen for 15 straight months. We've climbed about 20% along the way. Don't you think earnings itself is growing fast enough to justify further upside? I know you have a pretty bearish target here for the S&P right now.
Well, yeah, absolutely not, because this is a round trip from an earnings cycle reduction that was driven by the global energy commodity cycle, the dollar going from strength to extreme weakness at the bottom in Q1, which is already reversing. But the point is, 4 years ago in September 2014, earnings on the S&P 500, GAAP earnings that you don't go to jail for if you report them, were $106 a share. In the quarter just ended, March, they were 115. That's 4 years, 2% a year growth. And the only thing that happened is in between, they went down to 86, and now they've come back to 115. And yet, as we go forward, they're benefiting from a one-time tax cut that won't be recurring. They're benefiting from a very weak dollar that's springing back to life and will be getting even stronger as yields rise and dollar bonds become more attractive. So, and the most important thing is no one is factoring in the cost to the P&L of companies as interest rates rise on the 2 or 3 trillion of debt on the S&P and the 8 trillion on corporations generally. I've calculated that compared to 2016, even a 4% yield on the 10-year, which Jamie Dimon, it's not my number, Jamie Dimon says is likely or probable, would result in $50 a share after tax of reduced S&P earnings. So, you factor that in, you factor the strong dollar, the one-time tax cut, the fact that we've gone in a circle, but we're not really increasing on a trend basis tells me the whole earnings growth story is typical, Wall Street propaganda.